Welcome everyone. Happy Tuesday. It's good to see y'all. Nelsie, how's your day going? Nelsie, can you hear me? Maybe not. Guyana, how are you doing today?
I'm doing pretty well. I only had one class today, so it's been a pretty chill day.
Yeah, do you have more classes after this?
No, I just some studying to do, but yeah, how was your day?
Oh, it's been busy. I'm in San Francisco right now, at work. And so it's just been good to travel up here, but also been a really busy day. It's really exciting to end the day with you all. I have to deal with a lot of coworkers and things, and it's fun to be here. It's a different type of communicating and things like that. Arlene, how are you doing today?
I'm good.
Sweet. What are you looking forward to?
I think just see my friends tomorrow at school.
Yeah, that's sweet. I love that. I wish I could look forward to seeing my friends at school again too. But I'm not going to school anymore. So, um, all right, y'all. There is a poll that's going on in Zoom right now. I would love to hear sort of your thoughts on what that is, and those questions and such. Uh, if you're looking at the poll, you could probably pick up that today we're going to talk about money. We're going to talk about investing. We're going to talk about different ways to get your money to grow. And so I hope y'all are excited to learn about the different ways to take the money that you have right now, take the money that you will earn, and have it work for you. And so, in that, I'm super excited to talk about investments and real estate with you. Before we start, I want to pass it over to Chris to share some announcements as you all listen and take the poll. Um, and I will be back after Chris shares some words.
Thank you, Joseph, and good evening, everyone. Welcome to the second week of the spring semester. I just wanted to remind you all to kindly open your cameras at all times and also complete your display name because that will help us track your attendance accordingly. And if you have any audio or camera issues, feel free to inform our attendance staff, which is Will. So she can also take note of that for your attendance today. And if you are an alumni or a student leader, kindly put alumni or SL before your name because we'll be doing breakout rooms today and we really need your help. And enjoy the class. I'm going to pass it back to Joseph.
All right. Thanks, Chris. All right, please take the poll. Today, if we can get the screen share on, we're going to talk about um, um, stocks, bonds, and real estate. And so all of these things are investments and opportunities to have your money work for you. And so in that, this builds upon what we learned last week. If we can go to the next slide. So last week we covered mindset fundamentals. We looked at how key mindset concepts were and how a clear vision and intentional goals create direction and purpose. We learned about SMART goals, stretch challenges, and being able to step out of your comfort zone to really grow and have personal resilience. And we also thought through um, we also like realize through curiosity, reflection, and constant work that we can gain tools to show up and grow to be our best selves in the weeks ahead. And one of the ways that I know that every single one of you have on your mind is like money. Since money is such an important part of our society, of what you all are studying to do and what you'll need in the future, it's really important to really understand sort of how money can work for you. And so, if you think about mindset from last week, there's a ton of things that can be scary about investing. You may not know the word stocks, you may not know the word bond, you may not know the word real estate, and that's totally great, you know, because today we're going to learn all those things to equip you with the right resources um, in the future, to feel successful and confident about these things in the future. And so let's go to the next slide. And I would love to get someone's help in reading what's on the slide for me. And so I'm wondering if, Haiti, do you mind if you come off mute and read what's on the learning objectives for today?
Um, Learning or understanding how stocks, bonds, and real estate work as investment tools through ownership, lending, and property income, and how risk, time horizon, and compounding affect long-term results. Do you want me to read the second one too?
Yeah, go for it.
Distinguish between investment options like individual stocks, index funds, bonds, and REITs, and see how diversification reduces risk and supports steady growth. Identify when and why investors choose each asset types based on goals and risk tolerance, and learn how they work together in a balanced portfolio for long-term security and wealth building.
Great. Thank you so much, Haiti, for reading that for us. And so hopefully you all had a moment to take the poll. I'm going to end it right now. And I want to share the results with you to show y'all sort of how y'all are feeling about what we're going to learn today. And so in the first question, what scares you most about investing? So many of you said losing money. And the second reason of what scares you is that not understanding how it works. When you looked at the second question, you know what motivates you to start investing? Many of you want to build long-term wealth, and some of you want extra income, and some of you just want advice, from someone that you trust to dive into this. And based on what we're going to cover today, if you had to choose one investment, which one would seem safest to you? A lot of you put real estate and individual stocks was second. And I want to talk to you today to give you more information on how the other ones might be helpful as well. And so I am afraid of losing money, just like you all. I want to build long-term wealth, just like so many of you. And this content today also helped me, think about how I might go and start doing these things. And so I hope that for you, you feel lucky today because when I was your age, no one told me these things on how to taught me about like what bonds or stocks were, and I had to just figure it out. But I wish that if I were in high school again, or in college, I would have taken the time to understand this because these are tools that help so many of the richest people in the world maintain long-term wealth and achieve great success. And so in that, let's dive in and let's go to the next slide. And I just want to flag that I'm going to tell you things about, finance and investments. And this is all the things that I've picked up along my life that I want to pass on to you. But I'm not a financial advisor, and none of you should consider this as financial advice, but just facts and information that's going to help you make better decisions in the future as you decide to invest in any of the things that we talk about today. And so, in that, I just want to let you all know this because people are trained to actually be financial advisors, and you can talk to one if you would like, and they are actually legally responsible to actually give you advice to help you grow your wealth. You can treat me as just a mentor who knows some things a little bit more than you do at this point to really just teach you these things so you feel more confident having a conversation or making decisions of your own on how to invest. So let's go to the next slide. All right, so we're going to talk about stocks first and ownership and growth. I want to see, in an emoji reaction, how many of you have heard the word stocks before in a way that you can explain it to a friend? I want to see a raise of hands in emojis. Like, I want to see a hand raise emoji if you feel confident in talking about it. So I'm going to give you like 3 seconds to press that button. One, two, three. All right. Uh, Sheila feels like they can do it. And Chrysalin was very honest and was like, no. I appreciate both of your responses to like stand up and sort of show what you know. And I'm glad um, that Shayla, you know sort of it. But it sounds like a lot of folks could use a bit of an overview of what this is. And stocks represent ownership in a company. And so ownership in a company, if you were to ever become a business owner, you have the option to divide up ownership of the company into as many segments as you want. And those segments of ownership are called stocks. And so, for example, when Disney was formed, the Walt Disney, who founded the company, said that there were potentially like I don't know how many stocks that he actually divided the company into, but let's say he said for my company, Disney, like I am going to split this into 100 shares. A share is a unit of a stock to be able to then sell, to someone, to be able to say, okay, like I have an idea to start a business. I started a business and I'm going to sell part of my business to be able to raise more money. So I can then take that money and invest it into the growth of my business. And so let's say that you knew Walt Disney, and Walt Disney is like, hello, Nelsie, I want to sell you a stock, and you can give me $5 for a share of a stock. And then you own 1 share of Disney. And let's say that Disney goes from like something that's worth like if Walt Disney had 1 million shares and he sold each share for $5, that means that if all those shares are purchased, he would have $5 million. Um, and let's say that Disney is doing super well, and the value of the business is making more than $5 million. Let's say that the business is actually making like $10 million per year, which is 2x of the value of the business. And let's say that you wanted to sell your share of Disney. What you put in for $5 is now actually worth $10 because the company value doubled in that. And so your ownership of the company actually got you a big return on investment because what you put in for $5 is now worth $10. And so typically a growing business will have revenue that is tracked in the stock market, and that actually is how stocks are valued. And so stocks represent ownership in a company. And so you can benefit from stocks through price increases, and price increases go up when like the business is doing really well and it's making more money than is put in to run the business. And then the value of the stock increases. Um, Another way to benefit from the stock is something called dividends. Dividends are a way that a company that's doing really well can say, like, I'm going to take some of the profit that I've made and I'm going to give it to the shareholders and reward them for holding and owning part of my business. And so you as like a person who owns a stock can be paid a fraction of the profit to be able to help your bottom line as well and help you make more money. And so, in that, there are certain ways to invest in stocks. You can invest in individual stocks. You could say that I just want to buy 1 share of Disney, and all you do is buy an individual stock of Disney. But there are also things called index funds and ETFs. Who's ever heard of a word called index funds or ETFs? I want to see an emoji reaction if you've heard of index funds or ETFs before. All right, Mario's heard of it. That's great. Anyone else? Has anyone else heard of index funds and ETFs? All right, that's great. I'm about to tell you what an index fund is. And so an index fund is a group of stocks that are put into, like, you can imagine like a shopping cart. For example, you can buy a little bit of Disney and put it in the shopping cart. You can like in the shopping cart has Disney, Google, um, Facebook or Meta. All these companies that you know of are publicly traded and they're put into a basket of stocks called an index fund These index funds are managed by investment companies like Vanguard, Fidelity, Charles Schwab, to name a couple. And they are saying, like, I will put a basket of these stocks together and I'm going to sell them at some nominal rate. They're going to divide up that basket and allow you to buy a fraction of that basket. So you have representation across a wide variety of companies. And so instead of putting all your money into one company like Walt Disney, you can actually put your money in an index fund or ETF that is actually a representation of a certain set of stocks. And the most popular index funds are those that track something called like the S&P 500, the Dow Jones Industrial. These are basically the top companies in the world from a stock perspective. And you can buy an index fund that has coverage over a number of these companies that help you diversify your risk. So let's say that Disney is having a really bad quarter where they didn't make as much money as they thought and their stock price goes down. So if you put $5 into this company, your stock might be worth $2 dollars at the end because that one company is not doing so hot. But let's say that you put $5 into an index fund that represented the top 500 companies in the world. And let's say half these companies are having uh, a great time where their like prices triple over time. And let's say half of the companies are not doing so hot, and their stock goes down by a couple of percentages. Your tripling of half of those stocks in that basket and the like the the fall of some of those stocks in the basket get evened out, where you can actually have a majority of your money go up, even though some stocks in it go down. And so this concept of uh, you know, putting things into individual funds gives you the opportunity to do something called diversification, which manages the amount of risk that you have in this. So instead of putting all your eggs in one basket, you put your money into multiple things that could go well. And so generally, when you look at stocks rise and fall daily. But historically, when you look at the averages, um, stocks grow over a long period of time, not just over like a month or a year, but when you look at the stock trends across time, they actually go up and to the right. And so you can actually make, for example, last year, like my stock portfolio went up 50% because the stock market was doing really well. And so in that, there were some days where it was down, and there were some days that were up, but there are more up days than down. And so investing in stocks historically has been a really good thing for many people who choose to participate. Um, let's go to the next slide. So I want to give you a minute to think about all that I shared with you, to talk about and think about, would you prefer buying individual stocks or funds? Individual stocks, as I mentioned, is just like Disney as a stock, and a fund is like the top 500 companies in the world that you can buy into as well. Um, I want you to think about which one would you prefer, and why you made that decision, or what influenced sort of that choice. So take a minute to think about this, and then we'll come back after that. All right. to give you an opportunity to chat with your fellow champions to talk about sort of what your preference would be. There's no right or wrong answer to this question. Everyone gets to make their own decisions ultimately of how they want to use their money. And so I want to give you an opportunity to share sort of your perspectives in a group. And if you're a student leader or alumni leading the group, I'm going to look to you afterwards to share sort of the trends that you saw in the group and share out sort of a summary of that. So I want to give you about 4 minutes to talk amongst yourselves and we'll come back after that. Are we ready for breakout rooms?
Yes.
All right. I'll see you all in a couple of minutes. Okay, I'm going to be right back. I need to get some water, Chris. All right, everyone, welcome back. I hope that you enjoyed chatting with your fellow peers and champions. I'm super curious to hear how your rooms went and what you all learned from each other. And so, um, Kayla, I'm curious to hear from you. How did your room go? What did y'all say?
Most of us pretty much said that we preferred funds, and it was mostly because there was a lower risk, it was lower maintenance, and it kind of works a little better long term compared to individual stocks, which were pretty risky to take.
Yeah, I think that makes a lot of sense if you're just getting started and you want a more conservative approach. Funds are a great option for that. Thanks for sharing. Micaiah, I'm curious from you. How's your room?
My room was good. There was a lot of mixed answers. So myself, I said that I would prefer funds because they're more diversified and less risky than individual stocks. And some members kind of mostly said it was kind of like 50-50 because somebody said they would prefer stocks, and then somebody else said they would prefer funds because of my same reason. So it was like in the middle.
Yeah. I guess why would someone I guess why did the person who wanted stocks want it? Why did they want stocks versus funds?
Because they said it was better long term.
Yeah. All right. There's some truth to that too. Like fund, they are more conservative. You have, more consistent upside, but there are some stocks that exist out there like Nvidia, which grew like 300% in the past like 2 years. And so you can get $1 and make it $300, in all of that. And that's like pretty amazing as well too. And then some individual stocks can do that, actually. So stocks are not always, the wrong choice. Sometimes they're the right choice, depending on if you've done the analysis to make that. So I'm glad that, you had a mixed room. So thanks for sharing, Micaiah. Brenda, how was your room?
Yeah, I was sharing a room with I think her name was Gianna, but we basically all like I think all of our groups said we would prefer buying stocks because like we just thought that it was a little bit safer because like if you can like put all of like you don't have to, you pick which stocks you're getting and like you just have to like do the analysis to see if like what you chose turns out right. Like so there are like more risks, but like you're choosing that. So
Yeah, I think you're definitely having a lot of agency to make your own decisions if you chose to do stocks. And there's a lot of people that prefer to do that too. Some people really like analysis, they really like a company. And so, yeah, that's a great answer too. And so in this, like investments in stocks is really based on your own perspective and desires on how you want to grow your wealth. Some people choose a conservative path of just choosing a basket of stocks that trace sort of like the top companies. And some people are really like convinced that certain stocks will help them, grow their wealth even faster, and they choose to do that. And so, in that, there's no wrong answer to this as long as you make a sensible decision in this. I think most people out there, like some of the best investors in the world, like Warren Buffett, advise people to choose funds because it is just the simplest way to grow your wealth versus picking stocks is sometimes hard. Some people are really good at it. Um, but if you wanted to take the easiest approach, Warren Buffett says choose funds, but it's really up to you and how you want to make that decision. So great job, everyone. Thanks for answering. Let's move on to the next slide. We're going to talk about bonds. And so I'm curious to hear from you all, or like see some emojis. Like, who has heard of bonds before? If you've heard of bonds, like, give me a heart emoji. All right, Guyana. Kayla's heard of bonds. That's great. Nelsie, you've heard of bonds. Awesome. Wow, that's a lot. That's great. I certainly did not know what a bond was when I was in high school, but I'm glad that so many of you do. And so, in that, what bonds are loans that give you are loans that you give to companies, governments, or cities. And so, instead of owning something, you're lending money. The issuer, which is the company, government, or city that issues the bonds, agrees to pay you back with interest. Most bonds pay interest called the coupon, and usually they pay out every 6 months. You receive these payments until the bond reaches its maturity date, which is the date that the issuer tells you that they're going to repay you the original amount of money that you invested, which is the principal. So the difference between different bonds offer different levels of safety and return. And so some of the most premium bonds that are out there in the whole world are US government bonds. These are considered the safest because the US government has sort of been um, a great entity that repays its debts. There are also investment grade corporate bonds that have more risk, but they offer more interest, meaning that if you put in $100, into a US government bond, their interest rate might be 2%, whereas an investment grade corporate bond might be like 5%. But the thing is that those investment grade bonds, like they, in theory, will pay you back, but there's also a risk where they may not. Like if a corporation goes bankrupt, you might not be able to get back your principal because they're no longer an entity that can have money that actually does that. And so in that, there's a little bit more risk. So you want to be able to, if you choose to choose investment grade bonds, you want to make sure that the company that you're buying a bond from or like uh, sending them money to is creditworthy or like you can trust that they're going to repay you that money. And there's research that you can do to be able to figure that out. There's also municipal bonds, which are issued by municipalities, which are states and cities that often come with tax advantages as well. Like if you own like a municipal bond, you might have some tax benefits that reduce your tax burden to pay back any gain from those bonds as well. So in terms of stability, many high quality bonds tend to be more stable than stocks. They aren't risk-free, but they usually move differently from the stock market. And owning bonds helps you protect your portfolio during many market declines, though this is not always true. And so my takeaway for you is that bonds add stability to your portfolio. They also add predictable income by the repayment of interest over time. And it's good to own both potential stocks, ETFs, index funds, or bonds as well in your investment strategy. They help create a steadier portfolio by balancing high growth and higher volatility through stocks. Volatility just means that your stocks will go up and down, whereas your bonds have a steady interest rate they pay out, and generally um, you will get back your principal. And so, in that, many investment companies and many financial advisors advise you to own both stocks and bonds to mitigate risk in your portfolio. Your portfolio is just how you're investing your money. And so, in that, this is another tool to help you grow your money, but also balance it from some of the ups and downs that you would achieve or that you would experience through stocks. And so, in that, I want to give you the opportunity to answer this next workbook question. So, let's go to the next slide. I want you to think about what situations in life might make adding bonds more important for you, versus just owning stocks. There might be situations that you can think of where you think adding bonds is going to be a good thing for your own portfolio in the future. So think about what scenarios would you want to have more stability in, versus just, the ups and downs that you might experience through stocks. And there's no wrong answer to this. There are many situations in life. And so think about a situation that you can imagine for yourself where you might have been in, where you would have valued more stability in how you might invest your money. So take a minute to think about that. All right. I hope that was enough time to fill out your workbook, think about this question. And I'm curious to hear from how some of you answered this question. Omar, how did you answer this question?
Wait, does my mic work?
Yep, I can hear you loud and clear.
Uh, they help us like overall lower the risk of our portfolio, and we have like more versatility. So, for example, when bonds could be helpful is like buying a car. Um, what was up? What happened? Okay. Wait, can you hear me?
Yep.
Um, mm, and for like the interest rates, I think you get charged less. Is that correct?
So you're actually being paid interest. So you're buying a bond for like $1,000 and you're
Oh, I
giving
see.
that to like a government and they're saying that I'm gonna pay you back 2% like per month, which is like $20. And so in that you can guarantee like a $20 uh like deposit into your bank account. And at the end of the bond, when the bond reaches the maturity date, you get back your $1,000. And the maturity date could be 6 months away, a year away, 5 years away. And so in that, it is like a way to guarantee that you're going to make some money. Might not be as fast as putting in the stock market, but that is like a the way that bonds work. Sorry, I forgot to explain that. But yeah, so if you want a stability and you want a like constant income, that's a way to get it.
Yeah. Thank you, Mister.
Um, I'm curious if Crystalline, how did you answer this question?
I just said like if there's an emergency and you need additional funds, since it's another source of income, they might be useful.
Yeah, I think that bonds are great for people that know that, there might be, an emergency situation where you might need extra income or you just know that, you don't want to experience, all your money going away. if like the stock market goes down. And so it's a great way to mitigate risk for emergency situations where you like might need the money. And if the stock market is down, you just don't want your wealth to disappear. And so emergency situations or downturns are like great ways of how you can use a bond to offset some of those particular situations. So thanks for answering, Chrysalin. Um, Emily, how did you answer this question?
I put that I feel like bonds would be more important to me when needing money to buy a house or a car or like needing quick cash, specifically like during emergencies, as mentioned.
Yeah, like I think if you know that you need to buy a house in the future, and this is like maybe 5 or 6 years away, and there's a way to say that I'm going to put some money in the stock market to grow with my goal of buying a house in like 6 years. And I also want to make sure that I don't lose all my wealth, but I also want to grow money too. And a bond can be used to be able to offset that risk as well. And so it's not to say that don't buy just bonds, or just buy stocks. It's a way to say, like, if I wanted to double dip and have the best of both worlds, like, how would I get the benefit of an upturn and how do I get a benefit of stability? Um, so that if there was a downturn, you at least have your bonds to keep you afloat. And if you're having like a great time in the stock market because all the stocks that you bought are going up, that just makes it faster to get to your goal. And so thanks for answering, Emily. And I hope that some of the examples that I shared like helps you understand how bonds can be used in different situations that you might have. Um, but I want to talk about our next investment to talk about. If we go to the next slide, this is real estate. And so I want to see from you all, give me a house emoji. If you have thought about real estate, if you know what real estate is, I want to see a house emoji. All right. At least Omar has heard of real estate. Has anyone else heard of real estate? Okay, I see Emily has heard of real estate. All right. Gianna's heard of real estate. All right. Some of you heard of it. Some of this word might be new for you. Um, but let's go over it. So, real estate is investing in physical property like a house, apartment, commercial buildings, land, to name a few. You can earn money in two ways from real estate. The value of your property grows, which is called appreciation. And this happens as your property becomes more desirable. Let's say that the school districts in your area become really good. That's a desired thing. And so people want to pour in money to live in that area. Or let's say that, like, your commercial building has a ton of like fancy things that open up around it and it raises sort of the cost that also leads to more appreciation as well. So appreciation is one way how you can earn money through real estate. The second way is rental income from tenants. So let's say that you own an apartment complex um, of 20 units, and every one of those 20 units is paying you $1,000 to live in it. So every month you get paid $1,000 per each unit, so you make $20,000 a month. And let's say the cost to pay your mortgage for the property and your electricity is like $10,000. That means that 20 minus 10 is $10,000 of profit that you can use to make money. And so that's considered rental income. And so, how real estate builds wealth is that over long periods of time, many real estate markets tend to rise in value, though growth depends heavily on location and economic situations. Rental income can provide steady cash flow when property is well managed and occupied. And so, in that, you might not have the ability to buy a house right now because you are quite young and you don't have a ton of money. But there are ways to invest in real estate without having to own property. There are these things called REITs or um, real estate real estate investment trusts, um, which lets you invest in companies that own buildings like apartments, warehouses, offices, or malls, which are a lower cost to buy. And they're actually easy to buy and sell. They act like stocks where you just buy like a share or two of a REIT. And then you can actually, as a property grows or the property value grows, your investment in that property or in that REIT also grows. And one benefit of this as well is that you don't have any landlord responsibilities. And so being a landlord has, responsibilities such as maintenance, repairs, taxes, insurance, and the risk of vacancies. Vacancies are not great because, let's say, in the 20 unit apartment that you own, and let's say like 50% of them are empty, that means that, and your costs are still $10,000 a month, you're not making any money, if you have some of those units be empty. And so there are no landlord responsibilities if you bought REITs because you're not really managing that. You're just benefiting from the ownership without any like expensive costs of that. And so if you do choose to own real estate, it comes with costs, as I mentioned before, but also real estate is harder to sell, meaning that it takes more time. You can put a house on the real estate market, and it can take like sometimes a month, sometimes 5 months to sell. And if you need the money ASAP, it's going to take a minute for you to be able to get those monies through real estate. And so uh, it might not be, if you need money fast and you expect to sell your property to get money fast, that expectation might be wrong with real estate. With REITs, you can probably sell a REIT a lot easier because it's just a share in sort of a company that owns a building. But owning real estate, it might take you more time to sell that. Some of the upsides of owning real estate is that it's a tangible asset. You can get rental income. It's historically strong against inflation, meaning that the cost or the value of your home will rise faster than inflation. And then it's great for long-term growth as your house or your property appreciates. The downsides is that it's expensive to buy real estate, You also have to manage responsibility. You have to manage that property, or you have to pay someone to do that for you. And so in your portfolio, as you think about bonds and stocks and real estate can also help you diversify because physical properties often behave differently from stocks and bonds. REITs also add diversification, though they tend to move more closely with the stock market than direct property ownership. And so, what I want you to take away is that real estate can offer both long-term value growth and also income. It adds diversification and stability to an investment strategy, whether through owning property directly or REITs. And so, in that, uh, that's real estate. I want to give you some time to think about um, real estate a little bit more. So we go to the next slide. There's a workbook question that asks you what interests you more about real estate, long-term value or rental income? And so long-term value, as we talked about, is appreciation, meaning that the value of your property goes up, and rental income is this recurring thing, assuming that your property is occupied, where your tenant will pay you money every month as well. So think about which one is what interests you more, and we'll talk about it afterwards. So let's take a minute to think about that. All right. Let's talk about this question. Um, Arlene, how did you answer this question?
I'm still trying to decide because I see like the pros in both, but I'm kind of leaning more towards the long-term value.
Yeah, can you say more about why you chose that one?
I think just because like eventually like the more your property is worth, like the more you could profit.
Yeah, I think that's a great desire for real estate. Like if you pick the right property and it grows, you can make a tremendous upside as well, just over time with minimal effort. I think the challenge there is that you have to have enough money to be able to buy a place to be able to do that. But great answer. Thanks for sharing with us, Arlene. Um, Mario, how did you answer this question?
And the fact that I able to invest in a house and like the value will not change at all.
Oh, so would you want to do you value long-term growth more or do you value sort of rental income more?
Long term value.
All right. Thanks for sharing. Yeah, I think that's a great reason to buy like real estate, to see your home appreciate and such. Um, let's hear from one more person. Sheila, how did you answer this question? Sheila?
I put long-term value mainly because with like rental income, like you will have to pay every month, and I feel like as time goes on, like it increases more like the amount that you pay rather than what you pay for long-term value.
Yeah, I would say that so rental income, people are paying you actually for that. But regardless of that, I think um, value and appreciation is a really powerful tool to help you grow your wealth. So thanks for sharing with us. Omar, did you have a thought to share?
Yeah. For me, but what interests me most about the real estate is earning rental income and having a steady income over time, and the idea of owning property so we can increase the value while also getting monthly income. And with real estate, it seems stable and it gives people control over their investments, and it's like a slow way to build their properties management.
Yeah, like you can play the game of Monopoly in real life and just accumulate a ton of real estate and grow your value and your wealth in that way. And both rental income and appreciation can benefit you. So, you don't have to pick one or the other. You can probably benefit from both if that's something that you want to do. So thanks for sharing. Um, we talked about a lot of things today. We talked about bonds, we talked about stocks and real estate. And I'm curious if anyone has any questions that I can answer to make things that I talked about a little bit more clear. Does anyone have any questions that they want to ask? All right. If not, that's totally fine. Let's talk about and go to the next slide. So next class, we're going to talk about your paycheck and how you understand that. So we're going to look at how your paycheck works from gross pay to net pay to understand, what does it mean to withhold taxes and what is a W-2 and how does that make any sense to me? We're going to learn how to read a pay stub and interpret tax forms to make informed decisions and avoid surprises when you have to pay taxes. And so we're going to give you some examples of how to master um, these basic building blocks of financial confidence and give you more control over your money in the future. So look forward to that. We're going to talk more about money so you can hopefully understand sort of how much money you make actually and how much goes to taxes and such. So let's go to the next slide. What I want to do is I want to give you a minute and 30 seconds to finish up any workbook questions. Your workbook is a solid way for you to earn points to make uh, money. And so take the next 90 seconds to finish up any workbook questions and complete the survey as well.
This isn't
All right, y'all. I hope that was enough time to finish up the workbook. Um, Your workbook is due at 5 p.m. on Friday. So if you didn't finish that up, you have at least until then to get that in. And so I want to end with a couple of announcements for you all. The first one is about Junior Achievement Finance Park, which is on February 7th and 14th. You can choose one of those 2 days, and the deadline is in 3 days. And so please make a decision on which day you want to go to. This is a great way to apply some of the things that we're learning right now around investments and also your paycheck next week. And so this is a low stress way to start practicing some of the things that you learned in a real sort of simulated fashion in a fun way too. The second announcement is Ignite, which is a speaker series. The first speaker is going to be Miller McCoy. The date of the Ignite is on February 2nd. And so the deadline to RSVP is this Friday as well too, January 30th. And so if you want to earn points, this is a great way to learn from someone who's grown their own lives in a particular way, and get wisdom from them as well too. Um, One thing I would love to see more of is student leaders in this group. And so if you want to be a student leader, if you want to lead the breakout rooms as well, this is a great way for you to jump in and learn how to do that. We will train you, we will equip you. It's going to be great as well. There's also a college match program to let you know. And so if you're part of this program, um, you know, please fill it out. Two other things to talk about is the free Mustang immersive experience. And so, if you want to experience um, more of this, like there's an opportunity to do that as well too. And there's also if you're an alumni, there is a First Gen Career Institute that's open for spring 2026. And so this is a program that helps first generation students explore careers and build professional skills. And so if you're interested, there is a form to learn more about this. And so in that, definitely consider registering. It's a great program that we'd love to see you in as well. And so that's it for this week. Have a great rest of your week, and I will see you all real soon. Drop some emojis as you leave, and I'll see you all real soon. Have a great night, y'all. Bye.
Thank you, everyone. Thank you, Joseph. Have a great night.
Bye, everyone.